Well, actually, both projects are in production right now. The Mexican project is in the Oaxaca state, so southern Mexico, and was the company's first mine that they put in production in late 2011. And it's been producing at a fairly steady state of approximately 80 to 90,000 ounces per annum gold equivalent. So it is a polymetallic mine, so it's a function of both silver and gold, precious metals production, and then zinc, copper, and lead. And that mine, as mentioned, has been producing since 2011. It's quite a large operation. I visited the mine site in January, and although I've been with the company, or been advising the company for 10 years now, it was my first visit, and very impressive. Running at about 1,800 tons a day throughput on the mine site, and generating anywhere at current metals prices 20 to 25 million a year in free cash flow. The second mine is in Nevada. It's called Isabella Pearl, and it was in development up until about a month ago, and it has just started its gold production now. Now, it is a pure gold mine. It is a heap leach operation, so fairly simple operating parameters, and it will produce steady state about 40,000 ounces of gold a year. So on a combined basis, both mines will be producing approximately 120, maybe 130,000 ounces of gold equivalent per year. Through cash flow. Gold Resource Corp is unique, I would say, certainly from many of the companies that I follow, in that they have put 2 mines into production without using any debt. They effectively put the second mine into production using cash flow from the Mexican operation. It's called El Alguilia. And they have, their intent now is to obviously ramp up the second mine in Nevada and produce gold from that. The free cash flow on a combined basis could be as much as $50 to maybe $60 million a year at $1,300 gold. And most of that free cash flow, or certainly a large portion of it, is intended to be dividended out to shareholders. It's a good question. You know, I would say for the industry, it's typically 10 years. From the first discovery to development, to recognizing that you have an ore body that is potentially can be profitably mined. And then from that standpoint, the longer lead time items are financing and, of course, getting permitted. Because permitting a mine almost anywhere in the world these days is a bit more challenging than it was in previous decades. It was the cash flow from the El Alguilia mine that began the company's dividend policy. They were paying, that mine was making a lot of money, certainly when gold prices were at $1,800 and touched $1,900 an ounce. I should mention that that mine came into production just as gold had its big move, you know, from 2008, I guess, post-financial crisis, up to 2012, where it peaked. And so they came into production in a very strong gold price environment and had substantial excess profits and started paying a dividend as soon as they could. They pay a monthly dividend, and it's quite unique, or it is a unique company in that as a shareholder you can elect to take that dividend in cash or even in precious metals. So the company produces its own rounds, they're called. They look like a coin, but they're called a round, and they come in either silver or gold, and as a shareholder you can take your dividends physically. Typically, operations such, at least maybe looking at Gold Resource Corp and their Mexican operation, it is a polymetallic mine. So the ore that is on site and underground is made up of gold, silver, zinc, copper, and it is a underground mine. It's not open pit, and depending on the stratigraphy of the mine, those metals differ in concentration within that same ore body. So As an example, right now they are mining from a deep part of the mine, which happens to be base metals rich. So they're about 50% of the cash that is coming from that mine is in gold and silver, and 50% is in base metals. That will change as they start mining up and towards the surface, where there is a transition in the ore, and it goes from lower gold and silver grades to higher gold and silver grades, and vice versa with the base metals. I would say not so much that particular mine, because of the silver, the gold, the zinc, the lead, and the copper. And in fact, many good gold mines or gold mining companies like to have a mine that is polymetallic, because sometimes those run counter-cyclical. Sometimes you do have gold prices going up and other metals prices going down, and vice versa, base metals going up. So it's a nice steady state producer. Now with Isabella Pearl, their Nevada asset coming on stream, the company is definitely more leveraged to gold prices, because that is a pure gold mine. There's no silver, there's no base metals at all. It is producing 40,000 ounces of gold a year. Good question. That's a tough call. I mean, certainly if they were to buy the shares today at roughly, it trades on the company trades on the New York Stock Exchange. It's quite a liquid trader, trades $2 to $3 million worth of shares a day equivalent. But I dare say if you were to buy today, and obviously gold prices were to continue their rise, you would get maybe instant gratification. I'm telling my clients that this is a company to buy today and to take at least a 1 to 2 year view. And I believe you will get a very good return even with a flat gold price, because the company's intent is to pay out more free cash flow as a dividend than it does now. And with both mines on stream and no debt to service, because again, this company doesn't have any debt, they will generate quite a bit of free cash flow, and it is their intent to increase the current dividend, which is currently below 1% yield, to somewhere, I don't know, I mean, management will make a decision, but it could be as high as 5 or 6% at the current share price. And if that was to happen, then we would certainly get a bump in the equity value as people bought the shares for the dividend. So to answer your question, I would say conservatively 2 years, but you may get a very good return even after 1 year, with both mines generating free cash flow, and a big portion of that free cash flow being dividended to shareholders. As a background, this company IPO'd at $1 a share in 2007-8. They raised equity between 2008 and 2011 at higher and higher prices. They did private placements, primarily with some strategic investors, and they used that money to put the mine into their first mine in Mexico into production. And then when the mine was in production and they started paying out the cash flow, this is where we had a really strong outperformance in the shares. And those shares peaked at $33 a share from $1 over that 4-year period. And the reason I believe the outperformance was, again, the dividend. So shares currently trade about $275, $280. That is about a market capitalization of 180 million currently. And if we make an assumption of both mines steady state, maybe fast forward 12 or 18 months of production, that's 120,000 ounces of production. I could see this company generating $50 million a year in cash flow. And so the shares are currently trading less than 4 times, let's say 2020, 2021 cash flow, which is, again, one of the best valued companies in the universe of gold stocks that I follow. The current CEO is a gentleman by the name of Jason Reed. He's in his late 40s. He started with the company in 2007 in a corporate development capacity. And his father and his uncle were actually the founders of the company. His father, Bill Reed, and the brother are geologists, and in fact, prior to the Mexican mine going into production, they had put together 6 previous mines, smaller mines, anywhere between 40 and 100,000 ounce production per annum mines into production. So it's not necessarily a family-run company, but certainly Jason Reed, the current CEO, took over from his father in 2014, operating the company. Management has still a very large stake. Founders and management have a very large stake in the company, and I would say closely held. Those individuals hold 15 to 20% of the company, and hence their incentive to pay out a dividend, or one of the incentives to pay out a dividend. Risks, certainly price of metal, I would say, is probably your number one risk. Although it's a small company, because it has no debt, often the downfall of many businesses, certainly mining companies, is having too heavy of a debt load. And then if you do go through a downturn, the cash flow from a downturn, meaning in metals prices, the amount of cash flow that is available to run the company and service the debt diminishes, and obviously then you can run into some issues. And we saw that actually in the downturn, the mining bear market, which arguably some may say we're still in, but certainly post 2012, and probably bottoming in 2015-16, where a lot of companies couldn't service their debt, and the debt providers ended up owning the assets. So definitely metals prices as a risk, and otherwise I feel fairly comfortable with the risks associated with this company, simply because you are betting. Obviously, if you're going to buy the shares, you're betting on metals prices to either stay where they are or to improve. If you think gold or silver are going down, then typically you wouldn't buy a small gold mining company. Management's quite conservative. They don't grow. They will tell you, and in fact I think it's in their presentation, they don't like growth for growth's sake. They only grow when they feel there's need to grow. This most recent mine that they put into production, I think they're going to let it sort of mature, or at least the production ramp up. It's only been in production 1 month, so the ramp up to get from sort of a few ounces a day, if you will, to 40,000 ounces, it's going to take probably about 12 months. And I think maybe after 12 months, they will start looking for new assets. And again, they will build any assets that they find and decide to go into production, put in production. They will build from the cash flow that is being generated from those 2 mining operations. So I don't see them jumping from 120,000 ounces of production to 250,000 ounces of production, simply because they are a fairly conservative management. I'm a bit of a not a gold bug, but I'm a believer in the metal as an investment, certainly as a portion of any portfolio, both physical and in gold mining equities. So I'd like to think it's going higher. We have central bank buying, which is cropping up now. The likes of Kazakhstan, Russia are increasing their gold reserves, buying in the open market. Some will argue we're at peak gold right now, where production from all the gold mining companies globally on an aggregate basis will be going down going forward. So that obviously is bullish for gold. The biggest driver in my view though is the US dollar, and the dollar's been strong, let's say in the last 12 months if you look at the DXY, the dollar proxy. And in fact it's been strong, yet gold prices have held quite well. So if you're a believer of what Trump is trying to do in the US, I mean, he would like to see a weaker dollar. There's chat already of the Fed lowering rates, which obviously would be negative for the dollar. So all those factors combined, I see gold prices higher in 1 year, definitely higher in 1 year than lower.